Hello, everyone. I can only assume we are live. Please hold for another 30 seconds, and then um, we will begin. I think we can just about begin. So, good morning, everyone. My name is George Lagarius. I'm the chief economist at Forbes Mazar. I am joined by our senior portfolio manager and 10-year colleague who I love presenting with, James Rawlinson. Um, so, before we begin, what is it that we will present to you today? We will present the realities of a world that was supposed to, well, to go to hell in a handbasket, really, just a few months ago. Um, the Strait of Hormuz has been closed now for, well, virtually closed, at least even in the past few weeks, for 4 months. And yet we haven't seen any major demand or even supply shocks to the global economy. Okay, slightly higher transportation prices, but that's about it. We haven't seen runaway inflation. We haven't seen a big hit to growth, recessions, and what have you. Before we start, there is a perspective that I really want to share. So I started working back in 2005, and one could say I'm a veteran of a fair amount of crisis. Um, I didn't experience the dot-com bubble, but I do remember it very vividly because also the local stock market in Athens had its big crash around that time. But I did experience as a professional the global financial crisis, arguably the most important financial crisis after 1930. I experienced Greece defaulting, Cyprus defaulting, my own bank defaulting. I experienced Brexit thereafter because because I moved to the UK for political stability. I experienced the pandemic. I experienced Donald Trump one. I experienced the pandemic where things, the lockdown was something unprecedented. Nothing was moving, and yet the stock market returned to positive performance within 16 days after dropping like 40%. I experienced what else was after the pandemic? It was the runaway inflation following that. We now have the Middle East issues for the last couple of years. There is always a good reason for the world to be destroyed, and there is a fair amount of reasons why one should not be invested. And we're not just talking about your financial investments, we're talking about any kind of investment, buying a house, investing in your business, and so on and so forth. What needs to be understood before we talk about anything else in this webinar is that most of the information people get come from the media. Okay, and I'm not talking about social media because that's not information. That's definition of misinformation. I'm talking about, mainstream media. Um, and I want to share this with you. So as the war started, about a month into it, I was called to in a TV channel to comment on it. Um, and the reporter asked me, the journalist asked me whether I think there's going to be a global recession. I said, no, I don't think there is a likelihood of that yet. If the straits remain closed for 5 or 6 months, then obviously we can talk about it again. And also, my belief was that the straits were too important to everyone to be kept closed, so a solution would present itself, and that had been my experience for all the previous crises. Right. Greece was destroyed 3 or 4 times in the previous decade, and people are still out and living their lives, and even investing. Greek stock market is actually prodigy in the past 2 or 3 years. Brexit happened, and you know what? London is still the Europe's biggest financial center. The pandemic happened. Yeah, sure, a little bit of inflation, a lot of inflation, a pullback in economic numbers, but we're all still here, and so on and so forth. The ability of the global economic and financial system to recover far outweighs any journalistic expectation built to provoke responses and get clicks. Because the rest of the story goes is that the journalist kept asking, but why don't you think there's going to be a recession? He was set on that narrative. And after I persisted 3 or 4 times saying, I just don't see a recession with the numbers I have in front of me, ask me again in 3 months, he went like, okay, Mr. Lagares, and then he shut me off. Okay, this is the dichotomy, right? When you think the world is surely coming to an end, you should take all your money from your investment, you should shut down your company, and so on and so forth. And then reality persists. So things happen. Of course, they happen. Sometimes they happen within the scope of weeks, sometimes they happen within the scope of decades. Okay, but there is also a selection bias here. We tend to look at in history about the things that have really made history, that really changed the world, right? And we forget the myriads of times when we were thought something was world changing, and eventually it turned out it wasn't. So please do participate in this webinar, because the last thing we do is, and we have zero incentives really to spread panic. And keep in mind that, yes, of course, things can always go wrong. We're talking about peace in the Middle East. It's the definition of things going wrong. But there is remarkable resilience built in the system, built in the financial economy, built in company boards. These are multi-trillion companies. They hire the best and the brightest. There's their CEOs, their CFOs, their COOs, and so on. And these people are just focused on finding solutions for their own firms. And sometimes, even when governments are not really good at finding solutions top down, you'd be surprised at what the bottom up can do. Okay, so sorry for the musings. I hope it didn't take too much time from the usual death by PowerPoint, but these were some sentiments I really wanted to share. So let's begin with the PowerPoint by all means. Next slide, please. Oh, yeah, of course. So the world continues to be we continue to use the lens we have always used, that disruption and deregulation. There's a lot of data out there that prevents governments from fiscally expanding, which means that prevents them from finding money to give to the NHS, to schools, to social benefits, and so on and so forth. And this breeds some resentment. So you get more nationalistic governments as everybody competes for growth. And that's how you get disruption. Now, desperate to find growth, what do? We compete for growth, that's your disruption, and also we deregulate. We cut the red tape as much as we can. Maybe a little bit more room today, but obviously we increase the probabilities of a crisis going forward. Next slide, please. Now, what we see is, generally speaking, borrowing costs have risen quite significantly. Um, they are up nearly 5% for the US, the long term, a lot more than that for the UK. So this goes back to the idea that this is a debt world. Okay, keep that in mind, because especially in the UK, The UK will usher in a new prime minister in the next few weeks, possibly in the face of Andy Burnham. He promises growth. He wants to deliver growth, just like every one of his predecessors. None of them is dishonest in this, but he just can't borrow to do it. Okay, so yes, he can reshuffle the economy a little bit to do it, but without, significant fiscal expansion in the last 30 or 40 years, growth is a very difficult thing to attain. Next slide, please. Um, uh, yeah, sorry. It's on my end. Apologies. We seem to have a problem with the slide pack. So, Maren, if you can lower the slide pack and if you can show my face, that would be great. Sorry about that. So we're going to do it without the slide pack. There were some older slides there that should not have been in there. We need to talk about two things. We need to talk about the Middle East, and we need to talk about the UK economy. So let's start by talking about the Middle East. So, Middle East, what do we know and what do we have? We have oil back at 70. We have even below 70, and we have an agreement, a so-called memorandum of understanding between Iran and the United States of America. There are several problems to this. The first problem is that no other countries from the wider region and involved in the wider conflict are involved in this. So Israel and Lebanon have been kept out of this deal, but the peace between them is instrumental to the success of this deal. Okay, so that's problem number one. Problem number two, we really have no visibility over what happens in the Strait of Hormuz after an initial 60-day of so-called free passage. Problem number three, there is free passage in theory. In practice, there are about 20 tankers making going through the straits every day. A third or a fifth on each day, because yesterday there were just 10. So a third or even a sixth of the daily average from before this crisis. And why does it happen? Because over the weekend, the guardians of the Iranian Revolution fired upon a ship. This one is a risk we had actually flagged before, that the fragmentation in the Iranian leadership could cause such incidents. You could have a rogue commander somewhere seeing a ship and just randomly firing at it. Okay, so our view and our base case scenario was that things will be resolved before they become problematic. Now they are on the road to being resolved, but we also see this as a messy process, one that will require patience and one with significant, of course, downside risks that something may go south. Having said that, we don't see the United States actively pursuing uh, uh, more military engagement. Also, and that's probably a good insider knowledge to have. A few weeks ago, in Piraeus, there is a biannual holiday called the Posidonia from the god Poseidon. This is the biggest shipping event in the world, happens every 2 years. And I attended some of these, and I heard some of the biggest ship owners. Greece has roughly one third of global shipping. Um, and I heard a few ship owners saying that they were not averse to paying the tolls in Hormuz. At the end of the day, they will just increase their fares as long as it guaranteed safe passage. So keep this in mind that ultimately, because the problem is in Hormuz, and the bigger part of the problem is that Iran wants toll. It wants the money from Hormuz and also control over it. If if companies could pay a toll, which guaranteed, absolutely guaranteed, though, free passage, ship owners said that they would be happy to pay it. Again, the problem is what guarantees. Can you trust the Iranian leadership to keep its promises? Are there any enforcement mechanisms that are reliable? So this is this is the bigger problem. Our base case is that things will still get resolved in time before, we run out of reserves and we have to work from home. But things will be messy. We're going to see repercussions going well into the end of this year. Not major repercussions. Part of the reason is weak demand for oil from China and very strong from production from the US. So if actually production in the next couple of months returns to where it was, Morgan Stanley even predicts a supply glut in oil. So this is a situation in Iran, and the big takeaway is that it's going to be messy. Our base case is that still this gets resolved even in the nick of time, without too many problems beyond the end of 2026 and the beginning of 2027. Of course, we're talking about two leaderships which are not necessarily too reliable. So um, we um, we of course reserve judgment. Now, let's talk about the other big issue, which is the UK. In the UK, we expect a new prime minister, presumably Andy Burnham, to take office. And that is, markets were initially scared because they were not sure what his intentions re fiscal discipline were. But ultimately, we saw them being a little bit more relaxed when they figured that he has good advisors like Goldman Sachs, former Goldman Sachs Jim O'Neill, and former Bank of England's chief economist Andy Haldane. Also, he did declare that he's going to be not fiscally conservative, but he's going to be fiscally disciplined. Um, and that relaxed markets up to a point. Like every one of his predecessors, he will have to go through a market test, one that only Liz Truss failed. I can he tell investors, can he calm investors as to whether the UK can manage its debt load? Now, here is the problem. Seven prime ministers in 10 years. With the exception of David Cameron, most of them were pressured by markets. David Cameron was pressured politically. And as we said, only Liz Truss failed the market test, but yet those prime ministers changed. And why is that? Because they cannot keep their fiscal promises. The problem for Andy Burnham is going to be the same problem that all his predecessors had, which is uh, to to find money to pay for the NHS, for schools, for defense, and what have you. He does have some plans to improve growth, like shifting the Bank of England's mandate a little bit towards growth, like initiating a growth ministry. These are all good plans, but ultimately it comes down to chronic underinvestment. The UK has 20% less investment than France, Germany, or the United States, for that matter, in the past few years. Now, um, thank you. Actually, it's a good time that you put up that slide. So, the third issue I wanted to discuss was hawkish central banks. So, the thing that happened and that was most important for investors in the past two months that we haven't spoken is central banks have turned a little bit more hawkish. So, why is that? It is because we have inflation from the Hormuz Strait. But George, oil prices are now down, so maybe they shouldn't be so hawkish. The problem is central banks know that prices, came down, but A, they don't know how long they're going to stay there, and B, they still need to assess the effects on the supply chain going forward. Maybe they need to be just a little bit more hawkish, which means aggressive with interest rates to prevent inflation from becoming entrenched. That is their sole raison d'etre, the sole reason for existence, preventing inflation from becoming uncertain. Now, the Fed has been fairly hawkish after Kevin Warsh, the new chair, took up his position. The Bank of England maintained interest rates like the Fed, but was also fairly hawkish in statement. The ECB, the European Central Bank, actually raised interest rates. Now, here's what you really need to know. Hawkish central banks are not great for the economy, to be sure. But when it comes to investments, maybe they're not that relevant. The central bank, take the Fed. The central bank, the US central bank, has been hiking interest rates very sharply since 2022. Now, 2022 arguably was a bad year for everyone. But look at what happened to equities thereafter. They are now 63% since the beginning of 2022. So 22, 23, 24, 25, and half of 26. They gave you 63% with an average of maybe 10% per annum. Okay, so interest rates are important in theory. In practice, equity markets especially, less so with bond markets, equity markets especially are not that much intimidated with hawkish central banks. So keep that in mind, because your asset allocation ultimately, how much you put in bonds, how much you put in equities, how much duration in bonds, that will be the difference, not the externality, but how you position for it and how your financial advisors are positioning for it. Which leaves me to one last comment before we go on to James Rawlinson. And since we were talking about equities, the so-called AI bubble, which is not quite a bubble, it is, extended valuations. A bubble is quite a different thing. A bubble is something which is completely crazy. Now, there are some issuers out there which behave completely irrationally, where you see, for example, a company trading 100 times its sales as opposed to 2 or 3 times the average. But ultimately, looking at valuations today, they are not that onerous. And that's where I will leave you with, because there's a lot of talk about AI bubbles, but ultimately, we think this is a manageable situation. Those companies are doing a lot of capital expenditure preparing for the next phase of the Industrial Revolution. But that is the area where James Rawlinson is probably better positioned to talk about things than I am.
Thanks very much, George, for that lead in. And I thought what you were saying was really interesting across all those topics. As George mentioned, I do want to touch on the potential AI bubble, and then move on to talk about markets and our portfolio performance. So moving on to the next slide, please. Obviously, there's a question that George asked, is AI at risk of being in a bubble? And that is a question he has to ask quite a lot because he's a chief economist. He has to think about the big picture. When we're looking at this more from a portfolio management point of view, which is where I'm coming from generally, we're really thinking about how much exposure do we want to this factor. Now, that isn't to say that there isn't signs of an AI bubble. There's a really interesting story about a company called Allbirds, which were a woolen shoe manufacturer. And they announced earlier this year that they were going to pivot into AI. That's a hell of a change of strategy, I think it has to be said. And the stock rallied over 500% on the day. So something like that is a real warning sign about over exuberance in the AI train. But where we're really coming from is other concerns. The first one really is, how much is AI likely to be used, and will it fulfill its promise? And this is a very open question. It's very difficult for us to work out in 5 years' time how much people will be using AI. But it is a question that perhaps large companies may be answering for us. Large companies tend to have a lot more information and data available to them than smaller companies. And I think this chart's really instructive, because for the first time, it looks like large companies are spending less on AI and smaller companies and mid-sized companies, which again, perhaps don't have as much data or information, are spending more. And what's interesting about the RAMP survey in particular, which is on here, is that they're not surveying large companies and asking them for their PR version of information about how they're going to use AI. This is purely the amount of money that RAMP are seeing spent on AI. If we move on to the next page, our other main concern is really about the spending required to build out this AI infrastructure. And we're expecting around $3 trillion needing to be spent by 2030. Now, this doesn't mean that companies can't be profitable, but it does have the potential to affect earnings. And what we are seeing recently is a massive reduction in stock buybacks in some of those massive companies in the US, which have historically done that quite a lot, such as Alphabet, Meta, and Microsoft. And they're, instead of giving these buybacks back to investors, and buybacks do tend to be very positive for equities, they are instead using this money for capex spending. Also, on the other side, rather than just capex spending from earnings, we're seeing companies like Google actually raising money through bond issuances. So you're really going to have to see a significant increase in earnings to justify all this spending rather than giving it back to investors. But on the next slide, we can really see the flip side of this argument and why we as a firm are actually overweight equities overall. Earnings growth remains really strong, and earnings growth really is the driver of equity returns over the long term. And this remains impressive, particularly in the US and emerging markets. So from our point of view, I think we expect the earnings still to be good in these AI names, but we're worried that it could become more stock specific. This year there've been some really good names in the area doing really well across the spectrum, those using AI and those creating chips as well. For example, Palantir's earnings were up 85% year on year. That's absolutely fantastic. Micron saw a major, it's a chip maker, saw major increase in its earnings in June, and that actually caused a rally in the whole sector. But on the other side, we are seeing names that are perhaps not doing quite as well. Broadcom, despite having some really good earnings, actually disappointed investors because their Q3 revenue guidance wasn't as high as expected. So again, I'll go back to the point. We're not too worried about this being a bubble so much, but we are concerned that markets are pricing for perfection, and this is looking like it could be a stock-specific upside with winners and losers in the space. And if we go on to the next slide, this perhaps really encapsulates this really well, because on this slide you can see on the right, the S&P 500 in market capitalization has increased about 9% year to date. Now, on the left-hand side, you can see the contribution from the SOX 8, and you've heard of the Mag 7, I imagine. The SOX 8 is the new game in town, and these are mainly chip manufacturers. And it should be noted that NVIDIA, as you can see in the notes at the bottom, is also in the SOX 8, and that's delivered about half the market capitalization increase in the S&P 500 this year, and that's from those chip manufacturers. If, however, we look at the Mag 6, which is the Mag 7 less NVIDIA, they are actually on average down year to date and have delivered negative capital appreciation for the S&P 500. So this is displaying very well the winners and losers this year. We think it's going to be difficult to predict who the winners and losers are going to be. So as an overall factor, we are deciding to be underweight for the time being. On the next slide, we're moving on to just how this affects markets in general. And it has been a really interesting year for markets overall, with developed markets up 10.5%, emerging markets up nearly 25%. And if you'd gone away I said a very similar thing last year, actually, because the markets did a very similar thing. There was a big issue at the start of the year. And if you'd come back in June, you'd been absolutely shocked last year by the tariff announcements. This year, you'd have been very shocked to have learned that there's a major conflict in the Middle East between the US and Iran. And yet, despite that, as I say, Developed markets are up 11%. That is well ahead of average of a normal year. And as I say, emerging markets are doing particularly well. Interestingly, emerging markets are doing particularly well. I'll go back to those chip makers. There are chip makers outside of the US, and the ones that are doing really well are really TSMC. You might have heard of them in Taiwan. And then there's Hynix and Samsung in Korea. And without those three names, actually, emerging markets are pretty much in line with developed markets. So that's a really interesting story there. Gold in the gold color, fortunately, is an area that we are actually underway. In Q1, it continued its really strong 2025 rally. However, we have seen increasing interest rate expectations this year, partly on that Iran-US conflict, and that's not a great environment for gold. So it's fallen 25-30% from its peak back to around 4,000. Oil has also had a pretty volatile year. Obviously, it did really quite well at the start of the conflict, however, has drifted downwards since as a resolution has looked more and more likely. Fixed income is near the bottom. It's not quite the bottom. Obviously, gold is at the bottom. However, fixed income, both corporate bonds and government bonds, have returned a meager about 1% year to date. And that actually has some capital loss in there because the yield or interest at the start of the year was around 4%. So at this time of the year, you've earned about 2% in interest, and there's about 1% capital loss in there due to yields rising slightly over the course of the year. And then in the middle, as I mentioned before, at around 10.5% is those developed markets, which we'll go on to on the next slide. So this is major markets or developed markets year to date, and at the bottom is the UK. And there's several factors to this. The first is the UK is quite energy dependent. We import energy, and so that's not necessarily something that's really helping our long-term growth. At the same time, the UK market is an interesting mix because there is quite a lot of energy companies in there. And at the start of the year, that was really doing quite well. But as that's petered off, the UK market has struggled a bit and really gone sideways because obviously we're seeing a lot more of that political uncertainty that George mentioned earlier. So we are underweight there, and it's been a good place to be underweight. On the other hand, Japan has continued its really strong form from 2025, and that's really on the back of governance reforms, which sees companies focusing a lot more on return on equity and just then delivering better earnings overall. Somewhere in the middle, slightly at the bottom, Europe, again, somewhat susceptible to energy prices. They are an energy importer, so like the UK, their growth and inflation picture has been affected by that factor. At the same time, I'd say over the previous 2 years, there have been some nice catalysts from areas like banks, from areas like defence that have been good catalysts for Europe doing quite well over the last 2 years. But there really hasn't been an obvious catalyst this year within Europe, and it's trading somewhere near the bottom. The US has had a very interesting year. At the start of the year, it struggled. Again, some of those AI names had a fairly slow start to the year. But the US is energy independent. So ironically, having been a main protagonist in the Strait of Hormuz issue, it's actually doing relatively well. The other point is that the US dollar is a safe haven. And so stocks denominated in dollars, even if they were going fairly sideways, would have done fairly well this year. And obviously, it does have quite a few of those semiconductor names in there. So the next slide, if we move on to portfolios and performance. So how are we positioned? Well, first of all, I've mentioned this a few times. You can see at the top, we are really quite decent amount overweight equities, which has been a really good position year to date, as I showed that chart earlier. And in the middle, you can see we are a similar amount underweight fixed income. We are also, as you can see at the bottom, and I mentioned earlier, underweight gold, which has been mixed because at the start of the year that was feeling a little bit painful, but that's something that's really helped us in the last few months. And then also you can see at the bottom, we are overweight absolute return, which has really helped dampen some of that volatility over the course of the year. Within equities, I mentioned, and I'll probably mention this a few times. We are underweight equities. We are the main reason being we're concerned about the growth outlook. We are overweight emerging market equities where those earnings are coming through, and that's been an exciting place to be. And we are overweight US overall with a tilt away from mega cap tech and overweight in utilities, which again, overall has been a good place to be because the US so far this year has been one of the better developed markets to be in. Within fixed income, we are generally underweight duration, which I mentioned before, with yields rising. That's been a nice place to be. And then generally within fixed income, our preference is for emerging market bonds over high yield bonds and actually getting a nice little interest pickup there. Moving on to performance on the next slide. So this is year-to-date performance. This is to the end of May because that's where peer performance is available to. And in our lower risk portfolios, you're really seeing that lower amount of duration and underweight to gold really helping to drive outperformance versus peers. On the other end of the spectrum, our higher risk portfolios our overweight equity and overweight to emerging markets, again, really has seen some good outperformance against peers. And what is pleasing is that Aventure's performance around 9.1% is largely in line with global developed equity. So that's a really nice return there. On a 1 year basis, going on to the next slide. Yeah, here we are. So our more defensive portfolios, so defensive and cautious here, are somewhat in line with peers. As I mentioned, this year has been really quite good. Last year, there was a little bit of drag because we were underweight gold and 2025 was the year of gold. So overall, 1 year, a good performance, but that's really come more from this year than last year. However, looking at our more adventurous portfolios, it is really just an extending the gap over peers and good performance over really the whole of that 1 year. And then moving on to 5-year performance, this really is a similar story to the 1 year story. I think one thing to note in our more defensive models and looking at cautious in particular, the fact that it's managed to stay in line with that ARC Sterling Balanced Asset PCI index is really quite impressive, given the fact that it is a lower risk product than a balanced index is overall. And you see cautious and balanced straddling that, but cautious still managing to be in line, in fact, marginally outperform. And then in our high risk portfolios, Aventurous is doing exceptionally well versus peers. That 49.3% is about 8.3% annualized, and that compares to 5.3% annualized for the peers. So this outperformance really speaks to the consistent value we are adding for our clients over those peers. So moving on to conclusions and Q&A. If you can move on to the Q&A slide, because I think this conclusion is slightly out of date, and I'll just talk to the conclusion. So conclusions are really that inflationary pressures will persist for some time and supply chains will remain stressed. But assuming this deal goes through, that George has been talking about, we expect pressures to recede. Markets are grinding higher, helped by strong business fundamentals. I showed those earnings that are expected to come through. That's really helped to continue to drive equities over the course of this year. And valuations are mixed and not universally expensive. Meanwhile, as I just showed, portfolio performance remains positive over all time frames we report on and ahead of the peer group. So with that, we'll move on to questions. Now, first of all, I'm going to have a look at the questions that were submitted ahead of time. There were 3 or 4 questions submitted.
James, before we go into question, might
Sure.
I interrupt for a brief
Absolutely.
second? So there's something I want to say. I met Mr. Orlinson, as I said, a decade ago, when he was still a junior analyst. And I'm listening to him when we do those webinars. And in the past couple of years, I've actually been learning from him. He's a great person to follow on LinkedIn. And he's one of our most accomplished portfolio managers. Okay, so definitely a person I'd suggest you could follow. You should follow if you could. That's number one. Number two, We also have a fair amount of webinars from sector webinars. So we're looking into the pharma sector, into the consumer sector, and some more. So keep your eye on that space. If you're following Forbes Mazar in the UK on LinkedIn, it's the easiest way to find that stuff. If you're interested, in more specific sector insights. We are now doing a lot more of these webinars, and we're looking into specific sectors. Sorry to cut in your thunder there, James. You can continue with the Q&A.
Not a problem. That's very kind of you, George. And I would note my LinkedIn's interesting. I think George is about 3 times more interesting than mine. So definitely do check his out as well. So we had about 3 or 4 questions asked beforehand about I put in the bucket bracket of Andy Burnham. Hopefully George has answered that question for you. So we won't go over that again, but those we did have 3 or 4 questions asked on that. Another question we had was, why are the world's stock markets so high given the prevalent level of doom mongering? And I do think this is something that really George did cover off in his presentation. But just for me to add a couple of notes to that, I mean, I think it's always very important to note that the economy does not equal the stock market, first of all. So even when the economy is not necessarily doing very well, as George mentioned, these companies can often find ways to add value to create more earnings. They've got some of the best people working for them in their boardrooms and at various levels. So never doubt the ability of of companies to actually deliver really good earnings. But the other point is, as I showed earlier, earnings are actually coming through really strong and expected to continue to do so. And the US economy really is in a strong place. So what George mentioned, where you're seeing this negative news coming through from main media, actually this isn't necessarily the reality on the ground for a lot of those companies. A second question we had come through, I think George, you're possibly best placed to answer this, is what next for the UK? How to get the lost 6%? I'm assuming that's the lost GDP since Brexit that's been estimated. And should we get our own AI?
So 6% GDP is lost growth compared to trend growth, which means that to get it back, the UK would have to outperform for a number of years. Now, I'm going to do the AI response. I'm not going to give you the probability of this actually happening, which I think is extremely low, but I'll give you the AI response of how this could happen. As if you asked AI, AI is always answer confidently. And the answer is it would take a lot. It would take the good relations with Europe to reduce all frictions. So, you could maintain um, some of the liberties attained after Brexit, but really trade must flow. So this is number one. And that also would mean coming into, a more comprehensive agreement, especially around financial services. It could mean finding lost, finding a huge improvement in productivity. So the AI revolution could, in theory, give a bump to everyone, not just the UK. In that scenario, of course, the UK economy might not necessarily outperform its peers, but at least it might outperform its own past. So there are some ways, but the problem. Okay, people who've been hearing me, James, for past years know that no economist is a huge fan of Brexit, obviously. Having said that, the UK's underperformance is not solely a Brexit factor. Um, Lack of fiscal space is the more is the bigger culprit. And that is not a very easily solvable answer because the UK has borrowed about as much as it can, and now it is in the crosshairs of markets. So, to increase growth, You can have more babies. That's usually 80% of growth there is demographics. Um, or you can increase productivity, so that's your AI revolution. Many countries, G7 countries, can't borrow at previous rates anyway. What are you left with? Deregulation. So you can do a deregulatory push, but that also means you're increasing risks going forward. Okay. There and a lot of things would have to go right. Many more things can go wrong. The more you take risks, the more likely that one of those risks will hit you in the future and then lower your growth in the future. So you could be buying more growth now and have more growth issues in the future. What I would suggest to answer this question honestly is no one should be obsessed about the growth that is lost. The UK needs to return back to trend growth, with the caveat of lower fiscal spending. So trend growth with lower fiscal spending, and that should be okay for the time being.
Thanks so much for answering that, George. I do want to know, I've only seen one comment come through. There's a very nice comment thanking George for his views, but I'm not seeing any other questions coming through. So I've got one more pre-prepared question, but if you can send some of those questions through, that would be great. The final question that I had from before the webinar is, why do economic commentators say that bond markets would react badly to the UK issuing additional debt? And would it matter whether underlying expenditure was capital infrastructure related to net zero or revenue? And is there really no headroom available? Now, George did just mention to say before, the UK is being beaten up by markets, by bond markets in particular, because there really isn't a hell of a lot of headroom. And what you really do see quite a lot of the time is anytime a government announces a policy that is outside of economic orthodoxy, you really are seeing some good yields, a good amount of yield rise. And Liz Truss was the prime example, but we did see some real yield rises over 2025 as well. Now, the thing that's really been keeping markets more placated recently is the commitment to fiscal rules. But with debt to GDP really high, over 100%, and projected to rise further, there really isn't a lot of extra room for spending. And there's very little grace coming from bond markets. So if the spending is absolutely designated for infrastructure and could increase growth, I think there's a potential bond markets might let it go. But generally speaking, I think that any extra spending that gets announced by governments is unlikely to be widely liked by bond markets overall. Okay, we do have two more questions that have just come through. What would be the impact on the wider region sector market space of a big AI crash? George, do you want to take that or should I take that?
I think we should both answer it. So,
Okay.
big AI crash, what would this look like? First of all, I'm not too sure. Nvidia is now one of the world's biggest companies. I'm not sure if it's still the world's biggest company, JR, in terms of market cap.
That is.
Could be, yeah. So it's trading 19 times its earnings, forward earnings, that is. I remember it trading triple digits. It's forward earnings. So at 19 times, a company with that amount of growth is not in bubble territory, to be sure. And Microsoft is trading at similar metrics. So there are some of the companies that are out there, especially some of the more recent IPOs that are, in terms of valuation, stratospheric. But we saw AI deflate a little bit. So that crash, I'm not sure what it would look like, in the sense that this is not the dot-com bubble. Now, still, let us assume it happens. What it would look like? It would have an impact on the real economy, to be sure, because those companies would stop spending on capital expenditure. Okay, in the past year or so, that capital expenditure, tech-related capital expenditure, has been almost singularly supporting US growth. So there is this. Um, the impact would be, of course, in the stock markets, as you know, they're very concentrated. We could see, I don't know, 20-30% pullback if that happened, and that's just me sticking my thumb up and based on previous experience. But as I said, we need to be clear. A lot of the very big Magnificent Seven names right now are not in bubble territory. Microsoft still has this unique advantage called Microsoft PowerPoint. The failure on my behalf, which is the one that you just witnessed, and more importantly, Microsoft Excel. You know, there's this going joke that the whole of the internet, the whole of the AI, everything you think in technology, at the bottom of it is probably just one single Excel somewhere. Okay, so Microsoft has this moat against everyone else, and so does NVIDIA. Without stratospheric valuations, one can't really call this a bubble. Okay, you can call some valuations of some companies really stretched. We can talk a lot about FOMO, fear of missing out, but a bubble, we're not in the definition of it. I don't know, JR, if you wanted to.
No, what I would focus on is the fact that obviously you mentioned before these are a large segment, especially of US indices, but even global indices. And one of the things that really helps often drive the US economy in particular is the wealth effect of equities being high. Americans talk a lot about their 401ks, which is, I think, equivalent to our SIPs. Now, their ability to spend is based on the value of those. And if we saw a big sell off in that area, I think that would affect American spending a lot as well from that effect, as well as the fact that they're going to spend less on chips, they're going to spend less in the real economy. So I think there would be an effect. It's very difficult to say how big it would be and whether it would cause a recession, but I think you're certainly looking at a slowdown in growth if there is a significant if there is a if the AI trade doesn't work out. And at the same time, I think as this is a little bit philosophical, but as a species and in terms of where do we move in the future, AI is the hopefully the next big improver of efficiency within our work. And if that doesn't work out, it's perhaps difficult to see where growth will come from in the future. Moving on to the next question. Do you think interest rates will go up or down over the next few months? Let's keep this one quick, George. For me, well, markets are actually predicting, but at the start of the year, markets predicted interest rates to go down, to fall in the US 3 or 4 times. Now they are predicting 1 or 2 increases in the US and UK. I think as far as we're concerned, we probably think that's gone a bit far, and actually the BOE and the Fed potentially keep rates on hold, especially if a Streets of Hormuz deal does continue. George, what are your thoughts?
Our base case, no rate hikes this year, with the risks on the upside, i.e., that there will be one from each region. But our base case is that it's a big risk to hike rates right now because if oil prices drop sharply and remain sharply down and remain down as they have been, then the central banks risk fighting the previous war.
We have a question. The UK economy has an ever-increasing tax burden. Are we at breaking point in terms of negatively affecting behaviours and the economy? Because I know
No.
you're answering some of that.
The answer is no, sorry. The UK economy, in terms of taxes, so are there too many taxes suggesting that we have an economic problem? You know what? I'm a Greek. I can answer this. That's not that's not how economies collapse. Okay, economies collapse from too much unsustainable debt that cannot be financed. Now, the UK does have one unique problem, which is a quarter of its debt is inflation linked. So if inflation goes up, suddenly there's no fiscal space because it needs to pay out its inflation linked bondholders. But none of this. Guys, I can't stress this enough, and I do have a vantage point on this. This is a G3, G4 economy. Okay, so there is a lot of talk, a lot of doom and gloom about, especially in the press, about the UK economy. I'm not saying it's in the best shape it's been. Things are a little bit miserable, but nowhere near crisis levels. So, in terms of breaking points, and that's sort of what I was addressing, John. But I do thank you very much for the comment. Sorry, SpaceX valuation, discuss. Here is my very brief comment. I think the valuation of the company is higher than where I expect most of its rockets to reach.
That's unfair. Its rockets have actually done quite well at coming in and out of the atmosphere, I think. I think what I would say, just moving this back to our portfolios, I would be very surprised if in any of our active funds, SpaceX ends up in them in the short term. Because when you have fundamental investors trying to work out future revenues and base a company off that, it's very hard to do when a company is currently losing money. So it may get into some of our passive options because index providers, it might get into particular indices depending on the rules. Some of them require a company to be profitable, some don't. So they might sneak in that way, but I wouldn't expect it to be in our active funds for some time, and certainly not until it starts making money.
Um, JR, sorry, because they keep coming in. I do love the engagement. Let's try to speed answer. There's three now.
Yeah.
What is,
I just also just want to highlight we're not giving any investment advice on
of
equity.
course, of course.
That's just a
What is the risk of AI investment bots increasing volatility and how serious fund management practice manages volatility? Here's my view on this. It's a very honest view. We have had quant investment embedded in markets for at least 20, for at least for at least 5 or 7 years now. Read Flash Boys by Michael Lewis. It's actually a very good book about this. The thing is that with AI, you might actually get less risks if you ask me why, because quant management can be dumb. I sell, James sells, so everyone else follows. Everybody else's bots follow. But with AI, you might actually get smarter responses.
Hmm.
So keep that one in mind. I think it's counterintuitive, but it could reduce risks. Of course, we don't really know. How do you view the potential for chip makers drawdown following the success of a Chinese large language model using much simpler chips? I'm not worried about the chip makers. Even China wants NVIDIA's chips. I'm worried about Anthropic, SpaceX in the Grok space, or OpenAI. Yes, I do think their models and their business models are going to be challenged. But in terms of chip makers, just for the way this goes. So NVIDIA creates a chip that's maybe 2 or 3 nanometers big. By comparison, the coronavirus is 150 nanometers big, and that's a small virus. The average virus is 300 nanometers big. Okay, so we're talking about 150th of in size of a virus. This is a chip by NVIDIA. Now, the Chinese are stringing chips which may be 20 nanometers big, but they're stringing a lot more of them together to achieve a similar result. I don't think that lowers the value. Everybody still wants the smaller size possible. So I'm not too worried about how the Chinese approach would necessarily affect the valuation of the big and the most advanced chip makers. I don't know, James, if you would agree or disagree with that.
What I would say is the biggest concern for me in chip makers is they've had a massive run up this year. So from a portfolio perspective, you look at something that's gone very far, and chips to a certain extent are a little bit of a commoditized, a little bit commoditized depending on the type of chip. Obviously, as you mentioned, NVIDIA design very specific ones, but the more generic ones perhaps will do very well for the next couple of years. Will they be good enough in 2 or 3 years' time? And then does that support the valuations that we're currently seeing? I suspect possibly not. So I'm going to disagree with you on that one, George.
And that's a fair point. How do you expect global warming to affect equities? The answer is personally, I don't, at least not in the short term. Long-term risks are obviously there, but except for insurers. So insurers have problems. And I'm not sure, what sort of clauses they will have to put in because what was previously an act of God, now it's a Tuesday.
Hmm.
Okay, so keep your eye on that space if you're worried about equities. But beyond that, equity markets are not a predictor of bad events. We could be living in a very bad earth, and you could still see, very high equity valuations.
Mm.
Views on the rental property markets, which is the final one. I don't have any. I don't know if James, you do.
I mean, I don't have, this is certainly not advice. Obviously, there are rumors around changes to um, getting rid of council tax and getting rid of stamp duty and replacing that with a land value tax, which I think really could affect the rental property market. There are rumors that the government really are hoping that the rental market becomes more of an institutionalized where large companies run it. But generally overall, it's an interesting one because it's been really weak over the last year and a half because of some of the changes that have come through. I expect that actually there may well be a rebound in the next year or two, but again, it's not an area that we look at strongly from our portfolios. And with that, I think
Um,
that's all the questions answered.
yes, and I do appreciate the engagement. And honestly, especially those of you who do follow these webinars, if you can come back with those questions, I assure you this is a part James and I enjoy the most. So thank you all for participating. And we'll see you at some point in the next 2.5 months.
Thank you so much for joining us.